Howdy folks, Mark here from Flipside Trading, and today we're going to take a look at the trades of the week ending in July 27th. First thing we want to note is that, there's a lot of moving parts associated with our economy, especially during this week, and we really want to focus on the idea of how earnings, what the Federal Reserve doing, and the overall announcement of what GDP, i.e. gross domestic product, kind of the largest economic indicator of the growth rate of our economy, how those fit together, and we distill that information and then make intelligent trading decisions. So we're going to do that in the context of two trades, right? The two trades we talked about are, we had an SPY, right? The S&P 500. We had a 281, 284 core vertical. And basically we set that out, supposed to expire on the 27th. We set it on the 11th. The idea there is that we're looking for about a 50% return, at 25 cents. We closed that early in order to get out for $20 profit, which probably kept us out of a really big hole, and we'll talk about why. And of course, Amazon, which had earnings right when GDP was announced, and what we did there to place a same-day trade in order to generate max profit. So without further ado, let's go ahead and dive into these two different looks here. So the first thing we'll do is we'll explore the charts, and we'll go to the S&P 500. Now, the thing you want to look at here is the Fed is trying to, come back to, we say, fiscal normalcy, and they have this huge $1 trillion balance sheet. So they're trying to get rid of, those assets by selling them. And basically what they've been doing, if you can see here, beginning pretty much in March, at the end of every month, the last 2 weeks, they go ahead and sell those assets. When they sell those assets, the broker-dealers are forced to buy them. And if they're forced to buy them, it takes away their buying power, and therefore there's not a lot of buying power left, so the market tends to go down. So we saw this in March. We saw it again here in April, right? We saw it again in May, and we saw it again in June, right? The last 2 weeks. So now it comes to July. We want to go ahead and probably take advantage of this trend, especially since in July, they're supposed to increase from selling $20 billion worth of assets per month to $30 billion. So we wait, and we go ahead and look for a signal. And that signal here is this island reversal. So what that happens is that when you kind of approach this resistance area, all right, kind of near a top, and you get a gap up and then a gap down, this is a very bearish signal. So we went ahead and said, okay, we want to go ahead and sell a credit spread. We're going to sell it above this resistance here at 281. And we're going to let time decay come in our favor. And then we're going to we sold it for 52 cents. And our goal was to sell it for 25. Well, that didn't quite happen, right? What's happening at the same time is that earnings are coming out here for the second quarter. Now, my assumption was that given we had $30 billion, we definitely would have seen, some type of pullback. Kind of in this nature, given the liquidity that the Fed was taking out of the market, which would kind of counteract earnings. Unfortunately, it didn't happen. You can see here is that the SPY really hugged this ADMA, which is the yellow line, kind of bounced off the 281, came back down, and you can see as it came back down, and we had this doji right here, this candlestick, which means it's indecision, right? The buyers and the sellers, no one's really in control. But on the next day, we kind of had this another inverted doji, and you can kind of tell that looks like the SPY was going to make a run, and that earnings, at least in the short term, were going to overwhelm and overcome potentially what was going on in association with the Fed buying those assets. So that morning, when we kind of bounced below the 8 EMA, we got out of that trade for at least 50 cents. And so that will basically cover your commissions. And sure enough, you can see that the 80 may hold. The whole idea of earnings, popped up this day here. We talked about the trade wars, and we're talking real time right now. It's about 1:15 Mountain. The market's closed at 2, and you can see that we're trading above the 281, which means that we'd be beyond the short strike. So all trades don't work, but that's how we monitor. That's how we took the information in. That's how we looked at the trade. And basically we got out at break even. So that was a good way to go. The next trade is a little more interesting, and that's back around Amazon. So let's go ahead and take a look at some things that would happen kind of in between. First of all, I came back from vacation on Thursday, and some of the crazy things that happened is that Facebook had earnings, and Facebook's when they had earnings they missed, and they missed big. They were down like 50 or 60 points, and basically for overall 20%. And what's really, really interesting about that is that Facebook was not like Netflix that also missed earnings. Netflix missed earnings was also down 40 points, but it kind of rallied afterwards. But you can kind of tell that when Facebook didn't rally, there was definitely some questioning in the market as far as earnings and valuations. So that was number one. Number two is that when we look at Amazon, we'll take a look at it here. And we'll go ahead and look at it from the daily perspective. We'll go ahead and blow it up for you. Okay, on the daily perspective. So here it is coming up, and then I got home. Here's the Thursday where I got back into the markets, and you can see that it gapped down, right? The day before earnings, it gapped down, 25 points and continued to push. So down here, overall in the day, we were down like 50 points. And it was just telling me that, wow, even though GDP was projected to be, up over 4, that something in the markets just wasn't quite right. And some of the trades we were looking at, we couldn't catch up to. And given that we didn't know where the market was going to, we decided to pass. And that was good because one of the trades we're looking at was Google, and a bullish trade. And Google right now is down 33, so we would have been in the wrong space. So it's always good to let the trades come to you. Now, the key thing is, let's take a look at what happened now that Amazon announced earnings, because everyone's like, wow, earnings, that's fantastic. Amazon went up 60 points. Well, it did, but not at the beginning, right? This is the after hours portion of what's going on right here with Amazon. And you can see right away at the open, it dropped another 60 or 70 points. And at one point, it was down 147. And the reason for that is because they missed revenue, okay? And then they realized that they crushed EPS so much is that they started running it back up, and you can see that it pushed up, way up here, all the way up to the kind of the 90, 95 range. Now, some people are asking me, well, why didn't you bet on earnings, right? You had a 60-point pull. Well, it's a number of different reasons, okay? Number one is when the earnings report comes out, there are really 5 different criteria that folks are looking at. And to know, right, from a layman's perspective, what each of these is in order to make a high probability bet is difficult. Some people can do it, God bless them, let them trade the market that way. I look at more, instead of trying to get all these right, is to say, what are we going to do afterwards in order to earn money once we have information that's out there, instead of trying to guess? Because, right, you try to understand earning per share. Okay, Amazon beat that. We're trying to understand revenue. Amazon didn't beat that. You can see what happened, right? You had the flush. The other thing folks look at is costs, right? Overall margin, and are they as profitable, or how's their spending going as far as capex? Then there's usually an industry metric. In the case of like a Netflix, it could be subscribers, and Facebook, it's more advertising revenue, impressions, cost per pieces, and then obviously the outlook. So to really understand and know what all 5 of those are going to be is difficult. And you can see here, right, you take a look at some of the biggies, Google and Amazon, yeah, they were up 5%, but Facebook was down 20% and Netflix was down 5%. And so if you really look at, if you're making those bets and you're in a bullish market, and if you bet bullish, you kind of breaking even, it's causing you a lot of angst. So therefore, we just try to trade on the backside. So we know that Amazon was up, so we're looking to see what happens to it the next day. But before the market opens the next day, the Fed announces what happens with GDP. So I'm going to pull up something I posted earlier in the morning. So GDP comes out at 6:30, the market opens at 7:30. And after you analyze and adjust the numbers, the key thing here, as you can see, is that, we'll make this bigger, is that the real GDP, even though it was broadcasted at 4.1, was really down around only 2.75%, right? This line right here. And the reason that is because the dollar has surged so much over the past 2 or 3 months. It's up 7%. And so if the dollar's up, the value of buying goods, or the value of goods they can buy, actually goes down. So your purchasing power really decreases. That and the effect that the way the GDP numbers are calculated by the Fed is that they see a lot of inventory buildup. They look at that as a positive and a GDP growth factor. Whereas there's probably another plausible explanation when you see inventory build up and kind of sitting in the docks and in the warehouses. In this case, because of the acrimony that's going on concerning trade wars, is that no one knows what to do with it and it's not being shipped. So instead of it having an outlook of it being sold, you really have kind of a gloomier outlook and saying, hey, the economy really isn't as strong as it needs to be, and we're not taking in the tax revenues in order to pay for the big tax cut that we had. So with that in the back of your mind, you wait and you see what happens when Amazon go ahead and opens. So we looked at Amazon. We'll look at it now. We'll go back to the 1 minute chart, and we'll go back actually to a 50 tick chart. And you see it opened here. And a tick chart is just kind of, the tick occurs every time that there's a transaction when someone buys or sells a share. What that does versus a time-based chart, it kind of gives you an idea of velocity instead of just timing. And you can see that it went up, but right away that and the markets started to drop. So when you break this opening low, let me show you where that is right here. I'll give you a line. When you break this opening low, that's kind of telling you it's a little bit bearish. So when we push down here, we got a lower low, a lower high, a lower low. So what that tells me is that right now at this point we have a bearish trend, right? That's the definition. So we take a look at so we say, okay, because it's overextended, because what GDP is going, we're going to go ahead and we're going to be bearish. So the question is, where do we be bearish? So we're going to take a look at our fibs, and if we come right through here and we draw, oh, sorry, that's the wrong tool. Sorry about that. Apologize. So our Fibonacci retracement, you can see that we really get back to the 50 or 60% retracement right here, which is kind of limit. So then as soon as we saw a lower low, which is basically this candle right here, we went ahead and posted the trade. And sure enough, right, when you look at this part of the market, it just dropped like a rock, right? It dropped, basically, 30, 40 points. So knowing that, we went ahead and placed, when it was up here high, we can gain a lot of premium. We placed our trade at 1905, 1910. And at this point in time at 125, it's basically, that's going to expire worthless. So we'll generate max profit on that. So there you have it, right? This is how we take the different pieces of information. This is how we distill them into actionable results. At the same time, we don't take trades when the market is showing signs of very big indecision. And I know everyone wants to do trades to make money, but this is the summertime. You got to be patient just a little bit. And if we do that, let the trades come to us. We'll keep our 90% rating, and we'll generate money for you guys in the future. So hope you enjoy. Have a great Friday. Enjoy the weekend, and we'll be back at it hard next week. Thanks. Talk to you soon.